Welcome to the Deep Dive. Today we're jumping right into Rev Group's second quarter fiscal 2025 earnings call.
That's right.
And if you were tuned in, the overall feeling, the takeaway right from the start seemed pretty positive, wouldn't you say?
Oh, absolutely. Management reported, well, a really strong performance for the quarter. It felt like, a lot of their longer term plans really started to click, especially in one key part of the business.
Yeah, we saw some pretty impressive numbers right off the bat that kind of tell that story. Consolidated net sales looked good year over year, particularly if you strip out the bus business they sold off last year.
Right.
And adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, plus those adjustments saw really significant growth. We're talking over 60% growth on that same like-for-like basis.
And what really stood out, I think, for this time of year was the cash flow. Really strong cash generation. Q2, historically, that's a time they use cash.
Right.
So generating over $117 million in operating cash flow, that's a big positive swing.
And they didn't just let that cash pile up, did they? They put some of it back to work buying shares, some meaningful repurchase activity in the quarter.
Exactly. So you've got strong financials, good operational execution, and returning cash to shareholders. Pretty solid all around.
Okay, so let's dig into those financials a bit more. Where did that strength really come from? Consolidated net sales landed at $629.1 million for the quarter.
Yeah, and last year's number was $616.9 million. But remember, that had about $33 million from the bus business they don't own anymore.
Good point.
So if you compare apples to apples, the ongoing business sales were actually up a healthy 7.7%.
Okay, and that adjusted EBITDA number, the profitability picture, even better, you said.
Way better. It hit $58.9 million. Compare that to just $37.5 million in Q2 last year. And again, if you adjust out the budget impact from last year, that growth was, well, a staggering 63.6%.
Wow. So where was the engine behind that kind of jump? Which part of the business was pulling the weight?
It was overwhelmingly driven by the specialty vehicle segment. That's your fire trucks, ambulances, that kind of thing. Their net sales hit $453.9 million.
Okay.
And if you take out that prior year bus impact, that's an increase of over 12%. So yeah, that segment really delivered.
Yeah, let's unpack that specialty vehicle performance. What specifically drove that kind of strength? What exactly is working so well there?
Well, it seems like it was a combination of factors all coming together nicely.
Yeah.
Production increases were key, especially in fire apparatus. They specifically called out their Spartan emergency response business.
Yes.
Setting new highs for unit shipments and sales since they bought the company. That's significant.
Definitely. What else?
They also saw benefits from a, let's say, favorable mix, selling more of the higher content ambulance units. Price realization helped too, making sure prices stuck. And importantly, big gains from their manufacturing efficiency initiative.
Efficiency gains, yeah. That's something they've been emphasizing for a while now. It sounds like those investments are really starting to bear fruit.
It certainly looks that way. They mentioned things like equipment upgrades, optimizing processes, workforce training, lean initiatives. It suggests that whole multi-year push to transform operations is genuinely translating into better throughput, getting more vehicles out the door, and probably lower costs too.
That makes sense. More units, better mix, holding the line on price, and making things more efficiently. Yeah, that's the formula for expanding margins.
It is. Yeah. And you saw it right there in the specialty vehicles adjusted EBITDA. It jumped to $56.3 million. That's a 74.3% increase if you back out the bus impact. It ties directly back to more volume, those efficiency gains kicking in and getting good prices, just strong operational execution.
And the backlog in specialty vehicles, that's still enormous, right? I mean, it hasn't shrunk much.
It is huge. They finished the quarter with a $4.3 billion backlog. It actually went up compared to last year.
Really?
Yeah, mainly because demand for fire trucks remains really strong, plus the effect of earlier pricing actions they took. Their book-to-bill ratio in Q2 was 1.1x.
Okay, book-to-bill. Maybe just quickly explain for listeners, what does 1.1x mean in simple terms?
Sure. It basically means that for every dollar of product they shipped out and booked as revenue in the quarter, they took in $1.10 worth of new orders.
Gotcha.
So even though they shipped a lot, the order book actually got a bit bigger.
But they also mentioned making progress on the duration of the backlog, like getting vehicles delivered faster.
Yes, that's a key point. They've managed to reduce the unit backlog, the number of vehicles waiting compared to where they ended fiscal 24. This focus on boosting throughput, building faster, shipping faster, that's a major reason behind some of the increased capital spending they're planning.
Right, which brings us to that CapEx increase. They specifically flagged, what was it, $20 million for their facility in Brandon, South Dakota? What's the plan there?
Yeah, that specific chunk of money is aimed right at expanding production capacity, both for their S-180 modular fire truck that's been a real success for them, faster delivery times, and also for their fully custom Spartan units. It also covers upgrades to things like painting and fabrication. It's all geared towards speeding up shipments, increasing that throughput, and ultimately cutting down those long wait times, especially in fire. And that's part of why the overall full-year CapEx guidance went up.
Okay, let's shift gears completely now. Let's talk about the recreational vehicle segment. The picture there looked, well, quite a bit different from specialty vehicles, didn't it?
It did, yeah. A different story. RV segment net sales came in at $175.3 million. That was actually down slightly, 2.4% compared to Q2 last year.
And the reason?
Mainly fewer unit shipments. It just reflects that softer demand in the overall RV market that the whole industry's been dealing with for a while now.
But I think they mentioned their brands actually held up better than the industry average.
They did, yeah. That was a definite positive spin they put on it. Their retail sales were down maybe 10% year over year, while the overall industry, according to stat surveys, was down closer to 13% over the last 12 months. So, yeah, they're navigating the downturn, but seem to be losing a bit less ground than average.
What about profitability then in the RV segment? How did that hold up?
Adjusted EBITDA for RVs was $10.9 million. That's down about 9.9% from last year. The main drag was clearly shipping fewer units.
Okay.
They also mentioned needing more dealer assistance on some models, incentives to help clear inventory, and just some ongoing inflationary cost pressures. They are, however, taking steps to cut costs to match the lower demand.
But despite those headwinds, they still managed to keep a decent margin, didn't they?
They did. They maintained a 6.2% adjusted EBITDA margin, which, in this kind of challenging market where you're having to offer dealer support, that's actually pretty respectable.
And the RV backlog, how does that compare to the huge specialty vehicle one?
Much, much smaller. And it was down slightly, about 2% year over year, sitting at $268 million. That's kind of expected, though, given the soft market and, dealers being pretty cautious about placing big new orders until they see retail really pick up.
What about inventory on dealer lots? That's been a big focus for the industry. Are things looking healthier there? Is that whole destocking process finally winding down?
Management seems to think so, yeah. They said inventory is definitely healthier now. The total number of their units on dealer lots was down 13% year over year at the end of April.
Okay.
And maybe more importantly, a much bigger chunk, 77% are the newer models, fiscal 25 or even 26. So it sounds like that process of heavily discounting and clearing out the older stuff is largely done, or at least well underway.
That sounds like a much better position for future wholesale orders then. And the Q2 book-to-bill in RV was 1.0x. Is that also seen as a positive signal?
It's definitely encouraging. A 1.0x means they booked exactly the same amount in new orders as they shipped. In a tough market, just holding steady like that is a decent sign. It supports their outlook for roughly flat year-over-year revenue in the second half.
Any glimmers of hope on the retail side? Any signs of life picking up there?
Well, they shared one small but maybe significant piece of data. April was apparently the first month in 28 months where they saw retail shipments actually increase sequentially compared to March.
Wow, 28 months.
Yeah, it's just one data point, obviously not a trend yet. But still, it's the first positive month-over-month sign they've reported in, well, over 2 years.
Okay, now here's where things got really interesting, I thought. The strategic moves. They announced they're actually getting out of one part of the RV business altogether.
That's right. Big news. They decided to sell off the Lance camper business. That's their brand for the non-motorized travel trailers and the truck campers.
And the reason?
The thinking is to focus their energy, their capital, on the motorized RV side, where they feel they have more scale and better profitability. They basically said Lance, while it's a good brand, just wasn't performing as well due to scale issues. And interestingly, operational challenges, partly because it's geographically separate from their main RV operations in Indiana.
Makes sense strategically. What was the financial hit from deciding to sell Lance?
Well, in Q2, they took a non-cash loss of $30 million. That's related to marking those assets down as held for sale. But that was partly offset by a $16.6 million income tax benefit.
Okay.
So those impacts are baked into the Q2 results and also factored into their updated guidance for the full year. Lance's actual operating results for Q2 were still included in the RV segment's numbers for that period.
And they also announced a leadership change in the RV segment.
Correct. Gary Gunter is taking over as president of the RV segment. He's replacing Mike Lancotti. Mike's planning to retire later this year, but he's sticking around for a bit as an executive advisor to help with the transition. They had good things to say about Mike Lancotti's time there, especially mentioning his work in turning around the Renegade RV business.
Okay, let's move over to the balance sheet and cash flow. You mentioned earlier that surprisingly strong cash generation in Q2. How exactly did they manage that?
Yeah, that $117 million in operating cash flow was a real highlight. It goes against their usual pattern of using cash in the first half, often to build inventory for the busy season.
Right.
So what drove it? Strong earnings definitely helped, but a big part was disciplined working capital management.
Working capital.
Yeah.
Break that down a bit. What specific things help the cash flow there?
Things like getting inventory levels down, both raw materials like chassis and also finished vehicles, particularly in the RV segment. They also got a boost from higher customer advances on those big specialty vehicle orders.
Oh, getting paid up front.
Exactly. Getting paid sooner on that big backlog helps cash flow. And there was also some favorable timing on when they paid their own bills, accounts payable. It just shows they're actively managing cash moving through the business.
And they sound pretty confident they can keep improving inventory levels.
They do. They specifically mentioned ongoing efforts to reduce how long they hold chassis and raw materials, and also trim down finished RVs sitting around. They definitely see more opportunities to optimize inventory in the medium term, which should be good for future cash flow.
And with all that cash, we already touched on the share buyback. They were pretty active there.
Very active. They spent $88.4 million in Q2 buying back 2.9 million shares.
Wow.
Yeah, the average price was about $30.70 a share. That's part of their existing $250 million buyback authorization.
Yeah.
And they explicitly said they see it as a compelling way to return value to shareholders right now.
Plus the regular dividend payment.
Right. Another $3.1 million went out as cash dividends in Q2. So add it all up. And they returned $91.5 million to shareholders just in the second quarter. And they declared the next regular 6-cent quarterly dividend too, payable in July.
So putting it all together, balance sheet looks really strong, plenty of liquidity.
Very much so. They've got plenty of available cash under their ABL facility. That's their asset-based credit line, about $263 million available there. And maybe the key metric, their leverage net debt compared to the last 12 months of adjusted EBITDA is super low, just 0.5x.
And what does a 0.5x leverage ratio really tell you? What's the significance of that?
It tells you they have very, very little debt relative to their earnings power. That gives them a ton of financial flexibility. They can pursue future strategic options, whether that's more internal investment, maybe making acquisitions, or even more shareholder returns. They're operating from a real position of strength.
And they did reiterate that investing back into the business organically is still the top priority for that capital.
Yes, that message came through loud and clear. Investing in their people, their processes, their equipment, things that drive growth, improve quality, foster innovation, that's priority number one. That S-180 modular fire truck program is a great example they pointed to. It was designed for faster delivery, more efficient manufacturing. And they've successfully expanded it now beyond just the Spartan brand to their Ferrara and KME brands too, leveraging that branded facility that's getting the new investment.
So all this strong performance, the strategic focus, it led them to update their guidance for the full fiscal year. And they actually raised it.
They did, yeah. Good news there. They bumped up the consolidated revenue guidance by $50 million. The new range is $2.35 billion to $2.45 billion. So the midpoint, $2.4 billion, that's about 8% growth over their adjusted pro forma revenue from fiscal 24.
And that increase is mostly coming from the strength in specialty vehicles.
Exactly. Specialty vehicle revenue is now forecast to grow in the low double digits year over year compared to its FY24 pro forma base. They expect revenue there to keep climbing sequentially, low single digits in Q3 and Q4. That adds up to mid-teens growth for the second half compared to last year's pro forma numbers.
What about the RV side? What's the full year revenue outlook there now?
That's guided to a range of $625 million to $650 million. What that implies is roughly flat revenue year over year for the second half of the fiscal year. And that's actually a little bit lower than what they previously expected. Seems they're building in a bit more caution about, potential consumer uncertainty, maybe still weighing on demand there.
And the bottom line, the profitability outlook. Did adjusted EBITDA guidance go up too?
Yes, it did. They raised the consolidated adjusted EBITDA guidance to a new range of $200 million to $220 million. The midpoint there, $210 million, that's a hefty 45% increase over their FY24 pro forma adjusted EBITDA.
Wow.
So the really strong first half, especially from specialty vehicles, combined with expecting even higher throughput from spec vehicles in the second half, that's largely offsetting the impact of some headwinds they see coming, particularly tariffs.
Ah, tariffs. Right. That was a pretty significant headwind they flagged for the second half. Let's talk about that.
Yeah, definitely a key topic. They acknowledge the supply chain environment is still, dynamic, and there's uncertainty around tariffs. Now, they don't have a ton of direct import exposure. Most manufacturing and sales are U.S.-based, materials mostly U.S.-sourced.
But
they do have some indirect exposure through components they buy from suppliers.
okay, so what's the estimated dollar impact they're expecting in the second half?
They put a number on it, roughly $15 million in tariff impacts expected in the back half of the year.
15 million. How does that break down?
About $5 million of that hits the RV segment.
Yeah.
It's mostly related to some imported luxury van chassis they use for certain Class B RVs. And importantly, that's a cost they said they cannot pass on to customers.
Ouch.
Yeah. The good news, though, is they're already working to limit that exposure going forward. They plan to switch future purchases to U.S. domestic plants once they use up the imported chassis they already have or have committed to.
Okay, so $5 million in RV. Where's the other $10 million?
That falls on the specialty vehicle segment. And it's related to non-chassis material costs, other components and materials that face tariffs.
So $15 million total headwind from tariffs in the second half. Can they actually manage through that and still hit the higher guidance range they just put out?
They express confidence that they can. They believe they can contain these impacts and still land within that updated guidance.
Wow.
The plan involves working closely with their vendors, maintaining operational discipline, strategic sourcing, and, crucially, relying on that expected increase in production throughput, especially in specialty vehicles, to help offset those extra costs.
Makes sense. Will these tariff issues potentially stick around into fiscal 26?
It looks like some will, yeah.
Yeah.
They anticipate that specialty vehicle non-chassis material headwind will probably be around a 2% to 2.5% impact in the first half of fiscal 26. The RV tariff issue, though, seems mostly contained to the second half of this fiscal year, FY25. It might spill a little into early 26, depending on exactly how fast they use up those remaining imported chassis. And just to be clear, their updated guidance includes the tariff impacts they know about right now, but it doesn't try to guess what might happen with future tariff policy changes.
Right. Always a wild card. Okay, let's dig into some of the more detailed points that came up during the Q&A session after the main presentation. They gave a bit more color on that tariff timing, didn't they?
They did, yeah. Basically reiterating that the RV tariff impact is mostly a second half FY25 thing, maybe creeping into early FY26 based on inventory burn. And the specialty vehicle non-chassis tariff, that's the roughly $10 million hit in the second half of FY25, with that potential 2% to 2.5% material cost headwind, then carrying over into the first half of FY26.
And what about the return on investment for that big $20 million spend at the Brandon plant? Did they give any more specifics on what they expect from that?
They describe the return simply as good. They emphasize the main goal for this investment, and really others too, is cutting down those lead times. Getting S180s out in under a year, speeding things up across all their fire and ambulance plants.
Right.
The idea is to drive more throughput, ship even more units than their current medium-term targets. That helps them absorb headwinds like tariffs. They're also investing in things like fabrication, paint, assembly across other plants too, aiming for similar efficiency benefits.
How does selling Lance affect their longer-term targets? They'd put out that 2027 intermediate EBITDA target of $310 million. Does getting rid of Lance change that?
According to management, no, not really. They pointed out that Lance makes up less than 10% of their total RV sales. And crucially, almost all the profit, the EBITDA in the RV segment, comes from the motorized units.
Got it.
So selling the non-motorized Lance business doesn't have a material impact on hitting that $310 million target for 2027. They sounded confident they can still get there, using these operational improvements and investments to fight off any potential future headwinds.
Okay. What about the situation with dealer assistance in RVs and those inventory levels? Are they expecting to keep offering incentives?
Yeah, they indicated they do expect that higher level of dealer assistance to continue in the second half of the year. Particularly, it sounds like, for the Class B RVs, where inventory levels might be a bit higher compared to other types. But big picture, they feel dealer inventory overall is pretty healthy now that the older units are largely cleared out. That positions them better for the upcoming FY26 models.
And that S180 program in specialty vehicles sounds like it's still going gangbusters.
Yeah, demand seems to remain really strong. And they've successfully rolled it out beyond just the Spartan brand. Now Ferrara and KME brands offer it too, all built in that Brandon plant that's getting the investment. And importantly, the margins on those S180 modular trucks are apparently comparable to their traditional custom trucks.
What about the overall demand trends for fire and ambulance? Are orders still pouring in at the same rate?
They mentioned that demand seems to be settling back towards the long-term historical trend levels. Right now, it's maybe still slightly above trend. Their expectation is that new orders in the back half of this fiscal year will probably align more closely with those normalized 10-year average levels.
Have they had to raise prices on new fire trucks or ambulances recently?
Nope. They were clear about that. No general price increases have been taken so far this fiscal year on any new orders coming in. And just as important, the units that are already sitting in that big backlog, they don't get repriced.
Okay. There was also that U.S. Senate investigation into fire truck delivery delays that hit the news a while back. Did they provide any update on that?
No specific update or comment was given on the Senate investigation during the call. They did say, though, that they don't expect it to impact their ability to price vehicles in the future.
And looking again at RVs wholesale versus retail, are they seeing any connection yet between the slightly better retail signs and potential wholesale orders?
Well, the retail side is showing those very early positive signs, like that April sequential uptick we talked about. The theory is that now that dealer inventory levels are healthier, having cleared out the old stuff, that should help drive better wholesale orders moving forward. Dealers are in a better spot to actually take on new units once they see retail demand improving consistently.
Right. Makes sense. Finally, what's their thinking on M&A, mergers and acquisitions? Are they looking to buy anything?
They said they're always looking, opportunistically at potential deals, but they reiterated pretty clearly that right now, organic investment, putting money back into their existing businesses, and share buybacks are the higher priorities for their capital.
So deals aren't off the table, but
they likely only consider something really significant, a needle-moving acquisition, if the perfect strategic opportunity came along. And they certainly have the balance sheet strength to do it if they wanted to.
Okay, really fascinating insights into the quarter and their outlook. Now, let's transition to our segment where we maybe kick around some highly speculative ideas based on everything we just heard. And just to be crystal clear, this is absolutely not financial advice.
No recommendations here.
Exactly. This is just us thinking out loud, exploring possibilities based on the call.
Right, sort of connecting the dots and seeing what hypothetical scenarios might emerge.
Okay. So given that clear divergence, you've got the real strength, the operational execution, the big backlog in specialty vehicles, plus the investments to boost that further. And then you contrast that with the, let's say, lingering softness in RVs, the decision to exit Lance, and that tariff headwind hitting both segments. One plausible, maybe speculative idea could be some kind of pair trade.
Yeah, you could definitely construct a scenario like that. Maybe you consider being, let's say, long Rev Group itself, betting that the market isn't fully appreciating the strength and execution in specialty vehicles and their ability to manage those headwinds and maybe beat expectations there.
Oh.
And then you might pair that by being short another company that's maybe a pure play RV manufacturer, especially one that might be less diversified, perhaps smaller scale, or maybe perceived as less equipped to handle the soft demand or absorb those tariff impacts effectively. So you're essentially betting on Rev Group's diversified model with that strong specialty vehicle engine to outperform a competitor more exposed to just the RV market challenges.
This one potential angle, yeah. Another way to look at it, focusing on the financials, that really strong cash generation, the super low leverage, that 0.5x net debt ratio.
Yeah, that's dead out.
And combine that with their stated priorities. Organic investment first, share buyback second. You could frame a speculative idea around optionality.
Optionality, what do you mean exactly? Well, it means that their strong balance sheet gives them a lot of flexibility, a lot of options that maybe the market isn't fully pricing in yet. So a speculative bullish take could be that there's potential for accelerated shareholder returns down the line, maybe bigger buybacks if the stock stays attractive, or the possibility of them using that balance sheet firepower for a really significant needle-moving acquisition if the right strategic target appears.
Ah, I see. So it's betting that management has more levers to pull to create value beyond just running the core business as well, thanks to that financial strength.
Precisely. It's betting on their ability to potentially unlock more value through smart capital deployment, whether internally or externally.
Those are definitely interesting scenarios to think about based purely on the information from the call. But again, we have to stress, this is just brainstorming, absolutely not financial advice or any kind of recommendation.
Definitely not. So just to quickly recap the main points, Rev Group put up a really strong second quarter. That was powered mostly by excellent operational performance and higher production, particularly in the specialty vehicle segment, think fire trucks and ambulances.
Right. And they're looking ahead, acknowledging headwinds like tariffs in the second half, but they seem confident they can manage through them. Confident enough, in fact, to raise their full-year guidance for both revenue and adjusted EBITDA, largely thanks to that ongoing strength expected in specialty vehicles.
They also made some strategic moves, like deciding to sell the Lance camper business. That sharpens their focus on the more scalable, profitable motorized RV side of things.
And underpinning all of this is a really solid balance sheet, very low debt, strong cash flow generation. That gives them the flexibility to keep investing in the business organically, which they say is priority one, and also return a good chunk of cash to shareholders through significant share buybacks.
Yeah, the overall picture seems to be one of leveraging their core operational strengths, particularly in specialty vehicles, maintaining financial discipline, and using that flexibility to navigate whatever the market throws at them next while trying to drive value.
A really solid quarter and an interesting outlook. So what's the one thing that really stands out to you from this whole deep dive? And remember, for everyone listening, everything we discuss here today is purely for informational purposes. It is definitely not a recommendation to buy, sell, or hold any stocks or securities. Any investment decisions you make should always be based on your own independent research and consultation with a professional financial advisor.